I would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whiteline. I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. Today is Monday, July 18th. Thank you very much for starting your week off right here with me. We're going to have kind of an interesting chat today. Before we get into that, though, I wanted to remind listeners the best way to get in contact with me is to find the website at www.therebelbroker.com. There you can click the link Contact the Rebel Broker in the upper right-hand corner. Send along any ideas, suggestions, observations, or questions that you might have. I'd be happy to reply. In addition, still going for the survey. I would really appreciate it if audience members could go over to the survey page. You can get a link to that, again, at therebelbroker.com. Very top of the page, red button. Click it. Help. It says complete survey to help the show. And just fill out, it's basically a few demographic-style questions to get to know the audience, to get to know the kind of folks that make up the audience. And I have noticed that you can submit the form without entering your email address. So there's that. Finally, I wanted to also encourage everyone to take part in this week's poll. You can find that in the show notes for any recent show. And this week's question is, should one show a week not be about real estate? This comes from a couple of different listener suggestions I've gotten over the last, I don't know, I guess it's been a while. I've been getting folks off and on asking if there could be either a portion of the show back when I used to do 3-hour shows. And now more recently, obviously, since I'm doing Monday through Friday shows, having one show a week that's sort of off topic, that's not really about real estate, that's about other things. Just thought I'd try to get the feeling of the rest of the listeners out there, the people who are willing to go in and jump in and take part in the poll. So you can go check out the show notes for that. You can also find the link to the survey in the show notes, and of course, there's also a link at the front page of the website to the audience survey as well. So if you could jump in and take care of that, that would be fantastic. That would be a big help in helping me grow the show. Now, on to today's topic, which is an interesting one. I don't think I've really discussed this one in a very long time. Back when I lived in the UK for a couple of years, and I would have chats with real estate people, the first time someone told me that they don't do 30-year fixed-rate mortgages in the UK, I was kind of surprised. It's such a staple in the United States, and I never imagined that the 30-year fixed-rate loan is a uniquely American thing. For anyone who doesn't know, the rest of the world does not do 30-year fixed-rate loans. And let's think about that for a second. If you were someone who was looking to loan money, or sell money, right? Because that's really what you're doing. And you want to get a decent return, well, you need to know what the value of money is over a period of time, right? So whenever you're looking to loan something, particularly money, you want to know what that thing will be worth when it's paid back. So for instance, if you know that the rate of inflation is going to be 2% for the next year, and really no one can estimate what inflation is going to be over anything longer than a year. In fact, most of the time that folks try to estimate what inflation is going to be for longer than a year, or even a year, they're wrong, right? Imagine the poor suckers that were trying to estimate what inflation was going to be just before the downturn, right? Their numbers were clearly very far off because it's hard to estimate these things. So as a lender of money, you would want to try to insulate yourself from that. So what would you do? Well, you would not agree on a rate today that's what you're going to get paid for the entire life of a 30-year loan. Because there's no telling what's going to happen during that 30 years. 30 years is a really long time. Now, one thing that has worked to the advantage of lenders and that they've realized psychologically is that most folks don't stick around for that 30 years. Most folks move every 5 to 7 years, or at least they used to. But what's interesting is, as we discussed last week and weeks prior to that, there seems to be a shift towards people wanting to hold their properties longer than before. Whether out of necessity or some other desire, really isn't, I guess if you're trying to figure out what problems to solve for people or what needs to satisfy, that's an important question. But for the purposes of this argument, all that matters is it's happening, which means that increases the level of risk on the part of lenders. So that makes it very understandable as to why the discussion is starting to come up now about whether or not the 30-year fixed-rate home mortgage will survive. Now, it hasn't always been around. It basically was born at a Depression-era housing, and it was a stimulus. It was to try to get people to buy homes, and it was created in 1938. Now, a lot of folks would argue that this is one of the very first building blocks of what created a marketplace that allowed ridiculous growth in home prices, because it suddenly became more reasonable to borrow more money. And you should rest assured, as someone operating in the real estate market, that the elimination of the 30-year fixed-rate mortgage has a very high probability of being an earth-shattering effect or an earth-shattering cause in our real estate world. Because imagine how much everything changes. Now, for some folks, it doesn't change at all. Perhaps it ends up simply, we just eliminate it entirely and we end up with the adjustable rate mortgage that sort of stays the way it is, where perhaps they agree to not adjusting the rates more than ever, like there's a 5-year adjustable rate, so for the first 5 years it doesn't adjust, those types of things. Maybe those instruments remain. But the folks over at Seeking Alpha, or at least the Mad Hedge Fund Trader, I don't even know what this guy's real name is talking a lot about how he thinks the 30-year fixed-rate mortgage is going to go away. And I've got some thoughts about that. I have some things that I consider to be, because I don't think this is a crazy discussion to have, frankly. I think that given the way the rest of the world works, given how we seem so interested in looking at what the rest of the world does, and even when their decisions are bad, doing what they're doing. Interesting examples. If you ever want to get a good example of really bad ways to handle downturns in your economy, look at Japan in the late 80s and early 90s. I don't know about you in terms of your memories of the 80s. You may have none. You may not have existed in the 80s. But if you look back at the popular movies that came out, Gung Ho and Rising Sun, and all, whether you were talking about a car manufacturing focused movie or a general business focused movie, by the year 2000, and even if you look at things like Blade Runner, by the year 2000, Japan was supposed to be running the world. Their businesses were more efficient. They were better at building stuff. They were better at getting things to market. All of these things that were supposed to be amazing about the Japanese economy. And a lot of American movies from the 80s kind of reflected this idea that we were on our way to being a second-class business empire or second-class business country compared to Japan. And then Japan took a huge dump. Their economy went into the tank, and they are still considered not out of that. It has been well over a decade. They call it the Black Decade, and primarily because everything they did seemed to make it worse. And what's interesting is we have done a large number of things in very much synchronized with the kind of stuff that Japan did to try to fix their problems. Now, is there an exact one-to-one relationship there? No, there's not. It's very similar, though. It's very interesting to note the similarities and also the differences. But what's key to understand is things change, right? Economies make U-turns from where we expect them to be. Expectations don't always meet with what you get in the end. And it's not always smart to look at other countries to determine what you should do, because most of the times you're dealing with different economic situations, or you're for some bizarre reason you're emulating things that folks have done that actually have intended to work for you. But and I get it. I kind of went off in the weeds a little bit there for a second. But the point I'm going for is we actually did this to ourselves in terms of passing this 30-year interest-free mortgage requirement a long time ago, and no one else did. And I'm not sure I want to focus too much on why other countries didn't, but it might be good to focus on why, if we really want to get more to a rational lending scheme, we may want to move away from the 30-year fixed-rate loan. Simply because it's absolutely hand-in-hand linked with things like Fannie and Freddie and programs that are created by the government, right? This was a created by the government thing. The 30-year fixed-rate loan wouldn't have existed if it hadn't been mandated. And for us as consumers, I don't think that the access to money that doesn't go up in cost on a year-to-year basis in terms of what it's going to cost you to have the loan, I don't think that benefit outweighs the downsides in terms of its long-term effects on a marketplace. Now, I can't blame everything that we're upset about in real estate on the 30-year fixed-rate loan. But I got to think that it's had a pretty substantial influence on a lot of the bad habits that we've gotten into in terms of buying, in terms of what our market's turned into. Now, one thing it has done is it's been great. It's been awesome financial candy, but it shifted the risk. This is what's weird about this one. People like to say, well, we don't want to go away from the 30-year fixed-rate loan because then all of the risk gets put on the shoulders of the borrower, which is relatively true, right? Because then you can potentially see your mortgage payments go up based on what's going on in the economy, if just like you would with a variable rate, right? But here's the thing. You're paying it anyway, whether you know it or not. Because while you're getting this great 30-year fixed-rate loan, which simply on paper may feel great and sound great, when it comes right down to it, the ultimate liability for that instrument ends up on the shoulders of government, which means you as taxpayers. So in supporting for its existence, you're having to do it with tax dollars. And we've already seen what happens when that crumbles. It ends up with bailouts like TARP. And the other bottom line is, it's another thing that gets the government too interwoven with financial institutions. And then what we end up with is a scenario where our government will actually, with a straight face, tell us that certain banks are too big to fail. They don't tell you why they're too big to fail. They don't tell you that your deposits are actually insured. They don't tell you that your loan isn't going to suddenly come due on your house if they fail. All of those things will get sold off as assets, right, if they go bankrupt. So the real possibility emerges that you could theoretically buy back your mortgage for far less than its end value, right? Not likely you're going to have whatever hundreds of thousands of dollars are left on your loan or whatever the negotiated amount might be for that loan. But the point is, you bear the weight of that candy, that 30-year fixed-rate loan, whether you like it or not. It's kind of circular. So you can either bear it more realistically on the backs of the people who take the loans and will have their amount that they're paying changing based on what the economy is doing and what interest rates are doing. Or, and this is interesting, you can have the risk distributed across all taxpayers. And it seems a little bit odd to distribute that load of burden onto the shoulders of those who don't want to buy, who don't have a mortgage, doesn't it? So I wanted to throw those thoughts out there before I got too much into this article from Seeking Alpha. I'm not sure I'm going to come down on one side or another. my instinct is to say that it would, in the long run, be a good thing for this to go away, but I'd want to look at it a lot longer, and I'd love to hear back on what you think. Now, before we get a little bit further into it, we're going to take a quick break, so don't go away, and we'll talk more about the 30-year fixed-rate mortgage right after this. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years' experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. All right, welcome back. Let's go ahead and jump in and hit some of the main points being made in this Seeking Alpha article. I think you'll find that a lot of them kind of fall in line with our initial discussion, but I'd love to. I'm interested to discuss this more, because I'm going to follow this up with what might we do if we made this decision. What would be the fallout? How would we manage this in terms of a marketplace? And does it mean that you just need to change how you're making decisions as buyers, sellers, and investors? So we'll get into it a little bit more. Now, as I said, they make the point here on Seeking Alpha that there's a good probability that this is going to go away. Quote, banks in all other countries only offer floating rate loans where interest rates are adjusted monthly, quarterly, or annually to reflect the ebb and flow of the bond market. So the homeowner assumes all the interest rate risk. Now, remember, we already mentioned that you're already kind of assuming this risk as a taxpayer. And I realize that's a far more distributed risk. But in this case, is that a fair distribution of the risk? And why does the government get involved in that risk in the first place? So those are some questions to ask yourself and see if it's something that makes sense. So if you borrow money to buy a house and interest rates remain unchanged or fall, then so does your monthly payment. If rates rise, then so does your monthly payment. If they rise a lot, then you are toast. The 30-year fixed only exists thanks to a massive government subsidy that comes in the form of the government-sponsored enterprises, Fannie Mae, Freddie Mac, we already discussed that a little bit. They buy home mortgages from banks, then they securitize them and sell them to end investors with a government guarantee. So let's remind ourselves what that means. So it's basically a way for banks to underwrite loans, and if they follow the rules set out by Fannie and Freddie and all those wonderful government folks, they can then sell that loan and its liabilities, or any liabilities that might occur in the future relating to that loan, to the government, to you. So in other words, the banks can get all of the upside with none of the downside. So the government, you, the taxpayer, takes all the credit risk away from the banks and puts it onto the government's books. Now, at the peak, Fannie and Freddie owned $5 trillion in debt. And that's what represents the big problem as far as the folks at Seeking Alpha think. When the financial crisis came along, it didn't take long for many of the government-sponsored entities' home loans to default. Now, remember, let's understand what default means. It means they stop making payments. Now, think back. If you haven't been listening to the show for more than this show or the last couple of shows, you might want to jump back a week or two, because we've covered an awful lot of things going on right now that are very scary in terms of how they mimic bad decisions made before the last downturn. Now, in shows a little further back, we've discussed how the roots of the problem of the last downturn actually were sown much earlier than that. You could easily argue 1995, 1994. You could even argue 1972, 1971. You could go all the way back to the Community Reinvestment Act, which then got used in 1994, which then caused problems in 1995. There's a lot of different things we could talk about there or go over again, but we've done past shows on those, so I'm just going to do the really quick and dirty version here. A lot of rules and regulations and things the government did to banks pushed this whole subprime lending scenario to where it is now, to where we ended up culminating in 2007, 2008. Over just the last few months, though, While I would have thought we've learned our lesson, we've seen non-FHA loans, so loans from Bank of America, Chase, Quicken Loans, all these other major players in the lending world doing 3% loans, doing 1% loans. Quicken Loans is doing a 1% loan. We've even talked about several large southern banks doing zero down loans. We've talked about cities buying mortgages. Plus, we've talked about how some of these loans, some of these zero down loans only require a 640 credit score, but we've also talked about the other side of that coin where credit standing is now being calculated differently. They're doing a modified calculation for the loan standing to calculate your credit rating that's including things that have nothing to do with credit. So if you pay your power bill on time, if you pay your water bill on time, if you pay your sewer bill, your trash bill, all these things are now going to be able to get counted towards your credit, which isn't credit. If you stop paying any of those bills, they simply turn off the service. So those aren't credit. Those occupy a completely different discipline mentally in terms of someone who's paying their bills every month. There's a totally different thing going on. That's not about money management, or it is. Of course, if you can't pay it, that's a bad thing. But it's a completely different plan, borrow, spend dynamic than it is when you actually borrow money, when you get a loan and you sign a piece of paper that says, I am borrowing this and I will pay it back on time. It's a completely different scenario. So the bottom line of that, the payoff of that change to lending and how we're calculated credit ratings is someone who now has a 640 credit score may have it, whereas if it was calculated in the old way, it might be below 600, right? Because we're using this modified calculation. There is still this irresistible need on the part of the government to scratch the loan people as much money as you can itch, right? They just can't seem to get away from it. And everyone still touts the numbers from the peak of the bubble as, gosh, so many people owned homes then. Well, yeah, and so many of them shouldn't have because they didn't really own it. We weren't doing any of those people favors. We saddled them with debt that they couldn't handle, and then when the economy turned, they ran. They abandoned their loans. We do not want to recreate that. That would be a bad thing. And sadly, we're kind of doing that again, and we're in a less robust position now to live through that than we were last time. Okay, so going on with the article again from Seeking Alpha, and I will be happy to include this in the show notes that you can find over at therebelbroker.com if you'd like to check them out. And I want you to remember what we just talked about as we move through some of these next points that they're making. Thanks to the credit excesses of the 2000s, liar's loans, and excess leverage, it turns out that many of the loans sold to them as prime credit were, in fact, junk. So let's define what that means. Liar's loans. Well, it's harder to do liar's loans now. I have seen some offers where less documentation is happening, but it's not near nothing, right? It's not quite like it was before. But does it need to be when we've modified the credit rating system so that a higher credit rating number, it doesn't represent the same kind of credit worthiness as it used to, right? That's almost like a liar loan, right? It's based on things that really don't tell you anything about your ability to repay or your credit standing. Excess leverage. Okay, well, it seems to me if you're getting a 100% loan, there's a high potential for there to be excess leverage there. Because if you get a 100% loan, even if you've just paid a little bit, you're likely to be upside down if the market doesn't continue to grow. You're basically banking that the market continues to grow in that situation, right? Many of the loans sold to them as prime credit were in fact junk. As we mentioned, the default rates of some mortgage-backed securities exceeded 50%. So imagine what might happen today given how we've mainstreamed so many of these loans. You've got major lenders now underwriting 1% and 0% loans. And even the 3% loans are a concern because remember, that gives you a very thin margin that property values can drop before borrowers are underwater. Now, it didn't take long for the GSE's capital to get completely wiped out. They effectively declared bankruptcy. The polite term was conservatorship. Some of you may remember this. And were only kept alive with a $360 billion government bailout. Now, remember what that means. That means money from you, That means $360 billion from you. So let's also remember what we talked about at the top of the show, where the burden for the 30-year fixed-rate mortgage is borne by everybody because the government's so involved, right? Now, it's also important to remember that there were lots of private shareholders who were invested in these securitized loans. Remember, that's what that means. You take a whole bunch of these loans, you bundle them together, and then you put them out there on the stock market for people to invest in. Now, let's remember who got hooked up in this. These were seen as normal, reliable investments. A lot of folks' retirements were wrapped up in this, unions, pensions, all types of things were wrapped up in this. Private shareholders in those two, Fannie Mae and Freddie Mac, were wiped out, and the stocks were delisted from the New York Stock Exchange. Right now, the two government-sponsored entities are stuck kind of in a holding pattern, and they're waiting for Congress to decide what's going to happen with them. The way things are going on right now, it's hard to imagine Congress deciding anything, frankly, relating to Fannie and Freddie. Even now, even with things as they are right this minute, Fannie and Freddie require over $150 billion in new capital just to operate independently again. And right now, Congress doesn't look like they're going to be willing to spend that kind of money. So make sure and get that point made in your head. Despite all the growth in prices that we've seen, despite all the quote-unquote recovery we've seen, we would still have to pump $150 billion into these two entities in order for them to start going out and doing what they did before. And the reason we bring that up is because a lot of folks out there who analyze the markets for a living think that, as far as Washington is concerned, these two entities are ready to go away. Now, here's the thing. Fannie and Freddie, these government-sponsored entities, are directly linked to the 30-year fixed-rate mortgage. And, of course, that means if those two things go away, so does the 30-year fixed-rate mortgage. Right? So we need to be mentally prepared as buyers, as sellers who may become buyers after we sell, as investors, for a time when how we borrow money is going to change, where it becomes much more of a variable in terms of our monthly expenses. Now, this is happening 2 years after the Federal Reserve is ending its quantitative easing program, which they say they're ending. At its highs, bought 50% of all the mortgage-backed securities issued, or about $40 billion a month. Now, a privatized 30-year market would probably boost rates by 200 basis points, up from the present 3.4% to 5.4%. Remember, it's 100 basis points for each interest rate point up, right? So a 1 full percent is 100 basis points. Or about what the average subprime borrower might have to cough up. So the picture that they paint here of what to expect is a monthly mortgage payment that could increase by 50% more than it is right now. And that would only be something you could avoid if you had a perfect FICO score of 750 or higher and you were willing to move all of your current financial transactions to your new lender, right? If you keep all of your financial actions in with this same organization that's lending the money, you could probably get a preferential rate. Now, just as we mentioned earlier, this may not impact as many folks simply because the average person sells their home after 4 years. But let's also look at this a little differently for a second. Yeah, okay, this is the effect it might have on what folks pay for their mortgage every month. But let's also think about what would happen to a landlord in this scenario. Now, I'm going on the assumption that we don't just instantly convert everyone to this kind of loan. My feeling would be that if this were to happen, it would have to be a phase out. In other words, if you've already got a 30-year mortgage, you've got a signed contract with someone that says, we're giving you a 30-year fixed-rate mortgage. What would have to happen is all of those mortgages would probably have to be honored for the life of the loan or until one party or the other eliminates it through either paying it off or reaching the agreed-upon conclusion. So there's that, which for me, as someone who likes the idea of investing in real estate and having an absolutely fixed amount of money per month that I'm going to have to worry about for that property in terms of budgeting, I love that. So that makes me a little bit more urgent in terms of maybe it's time for me to start acquiring a mortgage. Because here's what would happen. Let's say word started to get out that that there was going to be a moratorium or that things were going to go away for the 30-year fixed rate mortgage. Can you imagine the run that there would be for 30-year fixed rate mortgages? It would be insane. So you can't sit back and think, well, you know what, as soon as it looks real, I'll do something. Well, you can't. As soon as you do that, the amount it's going to cost you to get a 30-year mortgage on the front end is going to be nuts. Whether it's points you're paying, whether it's interest rates jumping because of the demand, whatever, the cost will jump up. Not as much as it would if you went with the new style loan, but still it would go up. And you might be, when you do the math, you might decide, well, you know what, given the possible variation over the course of 10 or 15 years of investment, even if I don't plan to keep the property for 30 years, the idea that I could invest in this thing and not ever have my mortgage costs go up by more, not ever have them go up at all, that's a pretty good bonus. So you might be willing to pay some of these extra points on it. But I don't think that's what you do. As soon as the word gets out, I don't think it makes sense for you to go crazy over that one. I think it makes more sense for you to do it now before there's a lot of buzz about it, before a lot of people are saying it's going to happen. A lot of folks refer to the 30-year fixed-rate mortgage as a dinosaur that doesn't really serve a purpose anymore. I'd argue that it doesn't. It's a lot like other things that become habitual. You come to rely on it and assume that it's there. I think what we would see is a lot more planning in terms of what we're doing with our loans. So maybe you only get a 5-year or a 10-year loan that has to be renegotiated. It becomes a lot more like a commercial loan where you end up renegotiating it after certain periods of time. I think a lot of different products would pop up that would facilitate the process. I think we'd probably return to a lot of products that probably haven't existed since the early 30s, and then a lot more would probably crop up. It might actually make it a little bit more interesting where you as a homeowner are going to decide, you know what, the plan is to stay here 5 years, 6 years, 8 years, 10 years, whatever, and shop for a product that's geared more towards that exact time frame. However, with an increase in housing costs in terms of the money that you have to borrow to buy it, there would be a commensurate reduction in the cost of housing, simply because a change like this, I think, would dramatically reduce the number of folks out there getting loans. However, I think in addition, you would also get folks who are being far more responsible about their borrowing. At least that would be my first instinct. I know I would be. I would absolutely be paying a lot more attention, thinking a lot more about what I'm doing if those were the circumstances under which I was having to make that economic decision, right? So they go on to say here, this is all another facet of an economy that is evolving at an accelerating rate. It is finding the true value of everything and repricing them accordingly at hyperspeed. I think that's kind of an interesting comment. But that's kind of where they let it go. They say to think about Amazon and books, iTunes and music, Netflix and movies, eBay and clothes. Suddenly things have gone from expensive to cheap while others make the trip from artificially cheap to expensive. The 30-year fixed rate loan is about to make that second trip, meaning artificially cheap to expensive. So I'd love to hear what you guys think about this. I actually think that the 30-year fixed rate mortgage is likely to go away. I think that there is a ridiculously good chance that within the next 5 years, there would be open discussion about the probabilities of getting rid of the 30-year fixed rate mortgage. And I think that the first signs that are going to happen, if you're looking for a warning flag, right? If you're looking for that, a warning flag that other people won't immediately get as a warning flag, will be open discussions about eliminating Fannie and Freddie. As soon as people start talking about getting rid of GSEs or government-sponsored entities, that's when you know that the news is about to hit the front page. Probably within some period of time. I don't know how quick. I guess it would depend on how serious the discussion gets. But sometime after that is when you're going to start hear people talking about what will happen to the 30-year fixed-rate mortgage. And everyone who's an investor should be very involved in understanding that, because it's going to have a direct effect on your future purchasing power and today, I think, should fit in with what your decisions are relating to your investment properties in terms of whether or not you really want to sell it. Maybe you were thinking about liquidating, getting rid of that investment property that you've got that has a fixed rate mortgage on it. Maybe you want to rethink that. If you're in positive cash flow with that property, maybe it's something you want to hold on to, because you'll never get cheaper money than the 30-year fixed rate mortgage. So yes, is the 30-year fixed rate mortgage a great way to borrow money? Yeah, it is. But it's all very lopsided to the borrower in terms of assumption of risk. There is no risk on the part of the borrower. You agree on an interest rate and it sticks to it for 30 years. I think that may be something that our children are not aware of when they actually get to the age where they're going to buy a house. So maybe it's something you might want to consider holding on to. Because I also think what this will mean is that there's going to be a lot more folks buying properties that are likely to put a lot more cash into it and finance less. We'll see how it goes. I mean, it may end up happening that way. I think it would at the beginning, simply because I think an awful lot of properties, after they've been on the market for a long time, would realize that it's a new dynamic, it's a new world now, and the price of homes are going to find themselves far more linked to what bonds are doing than anything else. Because if bonds are doing poorly, that means that the interest rates that people are paying to borrow the money aren't going to be doing so well. So that means they can afford to buy less. So that means that suddenly the whole line of buyers shifts downward in terms of how much they can afford to borrow, which means that they can therefore have to shift downward on the prices that they're shopping for homes. And a lot of folks at just above the bulge, the average price in a community, are going to find themselves with far fewer buyers, and it might will have to inspire them to drop their price if they want to sell it as quickly as possible. So anyway, lots of interesting things potentially on the horizon if this starts to happen. Of course, I'll keep an eye on it, and if it does start to make moves like it's actually going to come true, I'll of course share it here. Thanks for listening, everybody. You have no idea how thankful I am that you make this show a part of your day. As always, thanks for listening, and I'll talk to y'all next time.